We're snorting cap rates and shooting up cash flow here at Deal Junkies.
Welcome back to Deal Junkies.
I love it when you say that.
It's normally Gabe saying it, but I'm saying it today because I'm going to introduce our guest. I am Dane McKinney. I'm here with Gabe Johansson, Mike Nuss, Mark Gallegos, who's a frequent host, sometimes guest, and then our special guest, Rob Beardsley. Rob is the founder of Lone Star Capital. He founded it when he was, I actually don't know how old you were. I know that it was back in 2018, though, I believe. And since then, they have acquired over 5,000 apartment units. All of that, I believe, has been in Texas, in the major metros in Texas. That's over $750 million of real estate. Somewhere in there, you started a property management company to manage all your own assets. And you have also, in a down market, managed to average 25% AARs across all of your properties. So for your investors. So that's awesome. Rob, thanks for being here.
Excited to be here.
Rob, tell us where you're at. You're zooming in. You're our first Zoom guest.
Very cool. I'm honored to be your first Zoom guest. I'm zooming in here from our office in the One World Trade Center in New York. So we've got the corporate brain trust out here. And then, like you guys said, our portfolios right now fully focused on Texas.
So you're in New York running your portfolio in Texas.
Yep. So I've been on a plane more than I'd like to admit in the last month, but I'm hoping that that's winding down for the year.
What makes you guys put your brain trust that far away? Is there more money in New York?
You could say that. I mean, certainly there's been a lot of benefits of being out here. I think that New York is the best talent pool in probably the world. So we've been able to hire great people who are young, hungry, hardworking, smart. And then also there's a lot of capital here. And so you kind of rub shoulders with people that you might otherwise not. But the reality is when I was young, I mean, really before I even started the company at 21, I just had a dream to live in the city. I grew up in California. The grass is always greener. And it was just kind of couple circumstances came together for me to move out to New York and kind of pursue this dream.
So if I'm doing the math right, you're about 28 years old.
That's right.
It's incredible.
Wow.
And you started Lone Star Capital at 21.
I did. I co-founded it with a business partner, and we had a great run. And actually this year I bought him out of the business. So now I'm, not that I wasn't in control before, but now it's kind of fully on my shoulders for the good or the bad.
Wow.
Well, why don't you give us a snapshot, Rob? I know Dane rattled off some stats, but give us a picture of where you're at today and where you're heading, especially now you got more clarity of, you're at the helm. So,
yeah, we just closed on I think it's our 25th property last week. So that was really exciting because we hadn't closed any deal all year. So it was one of our longest kind of droughts, if you will. We were just not really seeing anything in the market that we liked, but super excited to finally close a deal in 2025. And that brings our portfolio pretty close to 800 million. We started acquiring in Texas back in 2018, started with one deal in 2018, one deal in 2019, couple deals in 2020, and just scaling from there. We've sold 2 properties, both in Houston, and those are the 25% AARs that we delivered to investors. We haven't made any other sales since 2022, and I think you guys, of all people, know why, right? The market changed dramatically in 2022, so that was the peak, and then from there, the market has been very, very different. So the challenges have been different, to where really a major focus on operations, capital preservation, making sure that our balance sheets are strong, our debt is in a good place, and our relationships are there. So it's been a lot of hard work to just make sure everything goes smoothly so that we keep everything going, and we want to keep the trust of our investors. A lot of people did well in the boom times. They made a lot of money for their investors, but then as things have come down to earth and worse, they have lost the trust of their investors, either through bad performance, bad communication, or other issues. So that's that's not us. We've got a long-term vision. We want to have our investors trust us for the long term and continue to invest for the next 50 years.
Mm-hmm. Can you take us back in time a little bit? I'm trying to figure out how you're 21 years old, you start this company, you end up in New York. Can you take us back to give us a little history about you and where this all starts? Like, what prepared you to launch something like this at such a young age?
Yeah, it's a great question. So starting from a baby, I grew up in Silicon Valley, and my parents ran a residential brokerage firm from home. So I was exposed to their real estate world from a very young age, but I also had a tech influence given being in Silicon Valley. So my thought was to go to college for computer science and get involved in like a tech startup. I had this entrepreneurial kind of spirit and thought I would funnel that towards tech because I saw my parents struggle in real estate and they said, oh, real estate's really hard. This is not glamorous. You should go and, create an app and sell it for $1 billion.
Mm-hmm.
So that was kind of my path. But then sure enough, while in college, I was just kind of figuring out, I'm a very practical guy. At the end of the day, I'm not like a moonshot kind of guy. I want to do something that's tried and true. And there's no more proven business than real estate, especially when it comes to multifamily, being a landlord, right? It's very different than the single family business that I was seeing from my parents because they were buying and selling homes for their clients. They were doing flips type of things and really not building any equity, not really doing anything that was building an enterprise for the long term. So when I saw the difference and the power of multifamily, which is just very simple, you're going from 1 unit to 100 units, and I saw the scalability, the way that I could build a team, the way that it would build a long-term equity, long-term value, that just hooked me. And that's when I realized that I had to just go in full and then eventually drop out after getting our first deal under contract.
So this was in college you made the decision?
Yeah.
So you did your first deal in college?
Well,
you dropped out and did it.
Yeah, I wrote the contract, dropped out, closed.
Wow. So what was step one when you decided you were going to get into multifamily? Because the first project you bought was 200 or so units, right around that number. So you're saying, hey, I should probably learn how to underwrite these things. There's a bunch of 60-year-old guys who have been in finance for 40 years who buy deals for a living, and they're looking at, I would assume, some of the same deals as you, and you made one pencil, right? Because I think that was one of the... Well, have you sold that first deal yet? Yeah. And so that was one of the deals that worked, right? So what was step one for you? And you're saying, like, I'm going to get into it. I think I'm going to start with 200 units while I live in a dorm.
I mean, well, really, I was benefited at the time with being young and dumb and just not knowing any better and having unfounded confidence. And so, whether that's good or bad, right, it worked out, but it could have also not worked out. But that was the key to it. Because honestly, knowing what I know today, I'd be too fearful to take that leap. I mean, I'm still fearful of putting a deal under contract today, mm-hmm. right? It could be much bigger in size. And that deal, we had to raise $4 million. And, today we raised $20 million on a deal that we closed last week. But it's still intimidating. So just really being naive and just being gung ho is what threw me into it. And once I was in it, I had no other choice but to succeed. But really that was why I was feeling comfortable to leap in. I was like, well, how hard could this be? If it's a good deal, I'll be able to raise the money. And I was just super wrong about that. First of all, right? Raising money is the hardest thing in the world. You got to have trust, and it's impossible to have trust when you're young, no track record, all these sorts of things. So the first few deals was not pretty. I mean, having to beg, borrow, and steal, and having to promise things and sell my soul in different ways, or to say, hey, I'll give you this part of the deal and we'll do this side letter and you can have my GP and you can have this. And it's worth it, right? At the end of the day, I kept telling myself, it doesn't matter if I don't make a dime on this first deal. It's just the value is in getting the deal done, getting the experience. And that's how we've moved on from there.
So you said the scalability, you love the idea of going from 1 to 100, but you started at 200. Why didn't you do what everybody else does and go buy a house or duplex?
Yeah, well, I guess I was smart enough at the time to join a mentorship program. I joined Joe Fairless's mentorship. I was listening to podcasts like this one, and Joe Fairless at the time had a big podcast that I was following, and he had a mentorship group. So I joined the mentorship group, and in that group, it's like, okay, I have examples in front of me of people who are doing this. And so they're not doing the duplex and the fourplex and then the 16 unit. They're doing the 200 unit deal. So I saw it and then had the belief once seeing it. And in that group also was a very valuable, it was, I had no idea how valuable joining that group would be, because in the end I was able to bring my deal, the very first one, to that group and say, hey guys, I need help. I got this deal under contract. I need help to close it. I'll do whatever you want. I'll give you whatever it takes. And that's kind of the bridge of trust that was able to make it work.
So did you find some investors in that group, or did they lead you to the money, or what'd they do? Just show you the systems, how to get there?
Well, it's very different when you need to raise money today, right? That's a very different skill set or behavior than needing to raise money 6 months down the road, right? When you want to raise money six months from now or years from now, I might recommend someone to write a book, to start a podcast, to, host a meetup, talk, meet people in person. But when you need money today, right, you just need to have meetings. You just need to get in front of people. And so in that group, I was able to get meetings with people who were legitimate investors, but also I was able to get in front of people who had their own network of investors. And, maybe it was their main business to raise capital for their own deals, but I was looking to entice them to partner with me.
How did you ultimately build their trust when you were so young and had not done a deal before?
Well, I think that you get lucky through large numbers. I mean, the amount of pounding the pavement that I had to do and the amount of no's I had to receive was enormous. So getting to those yeses was just like, okay, well, finally. So is it luck, or is it, 1 out of 1,000? It's just, it's really the brute force.
Numbers game. Yeah. And with every no, your pitch probably got a little better.
Yeah, it's true. I can't deny that.
On that note, how much did that deal change from the time you wrapped it up to the time you funded, from a GP structure or a, investor offering structure? I'm always curious on that first one, because it's kind of a moving target trying to get the first one done.
Yeah, I mean, we had very typical terms set up for the deal: 2% acquisition fee, 8% pref, 30% promote. And so that was the basic starting point. But then, of course, when talking to many investors, they might say, well, I'll take a chance on you, but I need a higher pref, or I want a share of your fees, or whatever the case might be. So I don't remember the exact details at this point, but let's say we had a partner who came in and said, I'm willing to raise $1 million with you. And then at that point, bring them in for a nice chunk of the GP. And then that's not also to mention the other big piece of the puzzle they have to solve is a loan guarantor, right? Most people like myself when starting out don't have the experience, don't have the net worth or the liquidity to qualify for a loan. And so that was another hurdle that we had to overcome, is bring someone onto the GP team who would satisfy that and navigate all these things with the lender. And that's all. It's like not things that we didn't think through everything, right? So it's just totally learn as you go.
You didn't know what to think through.
Yeah, exactly. So I can't recommend it, but at least I survived.
But you got it done. So how long of a closing was that? Did you have to extend? What was the timeline of actually getting the funding?
Yes. This is just such a funny story, because I'm 21 and my very first deal, the seller was a real estate operator in Texas, but they had KKR behind them. That was their equity. And this was a big portfolio, and they were selling off this asset. They had bought this deal super cheap out of foreclosure, barely did anything to fix it up. It was a super rundown deal. And KKR was the big money behind this bulk foreclosure purchase. And so now, come to find, I'm on the phone with these guys from KKR, and they're just dicks. And it's oh, you need an extension, we're going to murder you. And it's just, you need to put up more money by this time or you're dead. And I think it took 6 months to close, or maybe even a little longer.
If you said less than that, I would have been blown away.
Yeah.
That's
we
pretty
know
reasonable.
That pretty well.
Yeah. So how many LPs did you end up having on that deal then?
I wish I had more numbers at my fingertips. It had to be, I mean, for raising $4 million, if the average check is maybe, I'd say 50 investors, that sounds about right.
Whew.
Wow.
15 or 50?
50.
Wow.
50.
Yeah, that's a lot of work.
And who's managing all those investor relations? Was that all on you?
It was all on me at the time. Yeah, thank goodness, because I'm not a social guy. So I dreaded those meetings and kind of keeping up with everything. You know, I like numbers and I like pushing the ball forward, and that was tough for me. So now I'm really grateful to be in a position where I've got investor relations team, I've got amazing people on my side supporting me and making us look good.
So back when you were envisioning this whole path, you started in Texas, you're still in Texas. Like, how much of that did you actually design back then in college? And like, is it true to plan? Is everything going exactly? Because you mentioned, you kind of hinted on it, like you're still in Texas, but maybe it seems like you're going to open up more. So like maybe just speak to the design and where you're at today, for following through with that.
Yeah. So when we joined that mentorship group where there was those good relationships and stuff, that there's a big focus on Texas in that group. So it was very natural to just kind of find ourselves there. And so I was vaguely looking around, and then the numbers just happened to click better in Houston. And it's true till this day. And, you know, these are long-term trends, and I don't want to make too big of a prediction or a bold statement, but I do feel like Houston is super undervalued. And that's not to say it's perfect. It's not perfect, right? It has weather risk. It does have the stigma associated with oil and gas industry, but I do feel like given the valuations in Houston relative to the other major markets in Texas, and when you factor in the supply story, it's much more constructive, you know, way less supply in Houston than a market like Dallas. So I just think it's undervalued, underappreciated. So when we got our first deal there, it was only natural to get the next one there, because now we had a little more trust and reputation with the brokerage community, because that's the super tough thing as well, is you've got to fight the fight with the brokers. When you're an unknown quantity, you've got to somehow differentiate, somehow have a broker take a chance on you, which is a really nice feeling these days, where we are so well known and respected in the Houston brokerage community in particular that, I mean, we get first looks, we get last looks, we get a lot of love from brokers, and it's like, wow, this is where you need to be, right? Being the entrant is so difficult.
Mm-hmm. Okay. Yeah, that makes a lot of sense. So you kind of touched on some of the milestones, you know, getting that first deal done. Maybe the property management is another milestone. Maybe the buyout of your partners, and like maybe speak to some of the biggest milestones that are most clear in your eyes of what brought you to where you're at today, and like what you think really pushed you forward through that 8-year journey.
Closing the first deal is a massive milestone. You go from unproven to all of a sudden you're the man, right? Like you close literally one deal, and now all of a sudden all the brokers love you and can't wait to show you their next deal and stuff. So now deal flow is better. Investors now trust you a whole lot more. It's still not an easy conversation, because the next question is always, well, how many exits do you have? Yeah. Right. So you bought X amount of deals, but what about your exits? So we're still struggling with only 2 exits on our track record. We're hoping to sell 3 deals next year, 5 exits. That's starting to be shaping up nicely. But yeah, buying the first deal, that's a huge milestone. I would say next milestone would be the sale of the 2 deals that we did, right? Having those exits to kind of put an official stamp on some round trips to be able to have some case studies. That's really valuable. Bringing property management in-house was an important move for us, but I really regret to say that when we brought property management in-house, it started off well-intentioned. I do believe that, but it was just, it went wrong at some point. And basically what happened was the people we had in place for the property management were good, but they were only good at managing a small portfolio. And that worked until we grew and grew, till we grew very fast and it was not working anymore. And so then I had realized that the setup that we had was completely broken for, let's use rough numbers, 5,000 units. It worked for 500 units, but not for 5,000. So I realized that our foundation was sand. And so last year, I went down to Houston and I actually lived at one of our properties, just threw a mattress on the floor and just took over operations. And frankly, I fired every single person on the management staff. So it was a hard year, and it was a massive turnaround and rebuild where we rebuilt the foundation of the company from the ground up. And the reason why I regret it is because it's so much harder to build the right foundation when you're at this size and you have to rebuild it and play catch up rather than kind of build it right kind of before you really need it. Yeah, building it right the first time. So my biggest regret, which I know I'm kind of like marrying it to the milestone, is I just wish I had dedicated myself to the accounting, to the operations much earlier. But that's just how the game went. And at the time I was entrusting that side of the business with my business partner, and it was working until it didn't, right? Until we achieved a certain scale. So I'd say a massive milestone is just the way that we've rebuilt the company now. And now we're positioned to be a 5,000 unit company, 10,000 unit company, and beyond.
Mm-hmm. Yeah, I tuned into your webinar for I think the preserve at Copperleaf last year. Maybe it was Bear Creek, but I was expecting to see you in the One World Trade Center, and I saw you in what looked like a flat. I saw some flat white paint in the background with no artwork, and I said, I think he's at one of his properties right now. But honestly, when I saw that, I liked it. And then you explained, like, hey, I actually I got to be in Houston right now because I got to make sure that everything's operating the way it's supposed to be operating. And normally this isn't my job, but I had to take it upon myself to figure out what's going on down here because this is where we're hurting right now. And when I wasn't expecting that. I was just expecting to watch some institutional webinar on a property that was way out of my wheelhouse. But I kind of just wanted to learn about how you guys were maximizing on your deals and where you were getting the most efficiency. And it sounds like you guys have some tax credit benefits that come through, and we can talk about that in a minute because I have questions there. But that was like, man, if I were coming in and I had a $100,000 check to write, I probably would have written a $300,000 check. I would like, oh man, the CEO's sitting on the ground floor, like getting excited to optimize property management. Like that was, I liked that a lot. I'll wrap that up there, but I thought that was cool. So it's funny to hear that was not just that wasn't just a ploy. That was real. No, my year was spent in Houston trying to figure out how to make this thing work.
Yeah, that's right. I was at Preserve at Copperleaf. That was a nice place to call home. Yeah. And that deal is now the funny thing is that I picked to live at Preserve because it was our most recent deal that we had bought. Mm-hmm. And it was a nice deal because we own a lot of much worse assets, worse locations. So it was a good deal. Yeah. So it's not the fact that I had lived there that caused it to perform so well, right? There's other factors, just being that it's in a good location, it's good quality asset, but that deal is now our best performing asset in the portfolio. We've had tremendous success with it. We did the affordable housing play with the tax exemption, like you mentioned, and investors are loving that deal, and myself included.
Yeah, that's awesome. Is that in Katy?
No, it's not in Katy. It's actually in Copperfield, so it's a little bit more north of Katy, but we did close a deal that's very similar on the way to Katy. Okay.
Gotcha. That is where I was born. So that's why I was asking.
Okay, cool.
Yeah. So that was part of I thought it was funny just 'cause you bought an apartment complex like 2 miles from my childhood home. But I've been in Oregon for a long time now.
I've noticed that Texas, speak to Texas just a little bit. It's a different kind of market than other places you go. Like, what we look at here as a 50 unit is probably going to be 250 units in Texas. Like all the buildings are bigger. Does that make it easier for you to scale being in the Sun Belt, being in a market where there's a lot of land, a lot of places to build, and you can build these big projects? Does that help with the numbers?
I do like that on some level. I mean, what I would say, obviously, the fact that it's easy to build is not a good thing, right? Battling supply is not fun. So we want to be looking at every deal and thinking about, okay, what are the supply moats? Is there, for example, we might be in a location where it's just not economically attractive to develop because the average rents are $1,400, let's say, right? Developers not really going to come in there without some incentives to go build there. Otherwise, there might be maybe some sort of local municipality or some sort of zoning restrictions, even though Houston is known as this kind of Wild West where there's no zoning, but there are certain pockets that are hard to build in. So supply is very, very important to us. And then I do like the fact that there's just so many apartment buildings. There's so much product. So you can really evaluate a lot of deal flow. You can take your pick and hopefully pick the best deals out of the bunch rather than only having like a couple trades per year and the market's controlled by a few major players. And then, how do you get really in?
Do you think you'll stay in the Sun Belt as you expand?
I do. I think that our next market is going to be Phoenix. I think that Phoenix is a fantastic market. Investors love the market. It's got a lot of growth. It's hurting a lot right now. So I think there's going to be a good entry point now or in the near term. But I think we have a lot of work to do in Texas still. I want to expand our focus on Dallas. We only own 2 properties in Dallas. That's not acceptable. We need to have a bigger economies of scale there. Because we manage in-house, it's just really important to build that scale. I want to be able to have at least 5 properties in any market. Otherwise, it's just a big burden for us operationally to be driving across markets or on planes and just not being able to have those economies of scale.
Is your management leadership team there with you in New York, or are they boots on the ground? You've got offices in Texas, I assume?
Yeah, we have a mix. So, we have people on the management side here, but then we also have director of construction, director of operations, other operational personnel that are at the corporate level in Texas. Are
you building ground up or just doing rehab?
No, we're just buying existing. That's another thing about us and myself is like, I'm a simple guy. I want to try to keep things as simple as possible, and development is the opposite of that. So buy existing. And when it comes to buying existing, a lot of people love the value add play. They love to buy a deal that's a little bit older. Maybe it has, maybe whatever, it just has some upside, right? And so people love that play. But I think, frankly, that strategy has been played out for a few years now. And it's in part because of how popular it was. So every deal has been value added, right? There's very few deals that you can find that genuinely have not been purchased, renovated, flipped, then renovated again and again. And so we've shied away from some of those plans. So I think the 2 strategies that we've been loving the most is definitely number 1, the tax exemption strategy, because you're preserving affordable housing. So you're actually getting a lift in NOI through slight reduction in rents, big reduction in property taxes. So we really like that strategy. It's just kind of more of like a brain drain. It's brain damage pre-closing because it's all these politics and negotiations on affordable housing structures. And then the other thing we like is just we've been buying high quality real estate and not having any plan to renovate. Just saying, we think we're buying this at a discount. We plan on holding it for maybe 5-10 years. And it's kind of contrarian, which is funny to say because everyone's out there looking for the rehab deal, for the fixer upper. And so we've found over the last year or so, the deals that are just in fine shape are kind of a little underpriced.
I notice that the larger the syndication, the more focus becomes on stable cash flow. Would you agree with that? That for your investors, you're not looking so much for the huge equity pops as much as you're looking for stable assets that grow at a steady pace over, like you said, a little bit longer hold.
Yeah, I hope that to be true. I know there's a lot of people or a lot of companies like ours that are very much going after the 20% IRR, 30% IRR. And I think that they're taking on more risk than they probably realize, or certainly their investors realize. So I'm not a big fan of that. I do think that getting to that more mature phase where you're buying properties that are higher quality, that are in better locations, and the business plan is lower risk, which typically means you've got a longer term outlook, longer term debt, less leverage. I really think that serves investors best for the most part.
What makes a property high quality in your eyes? Is it build characteristics, amenities, location? Like when you are assessing a property, like you said, the Copperfield one, it's one of your nicer properties. Like what puts it into that bucket in your eyes?
Yeah, well, and it's cliche, right? Because everyone talks about real estate obviously being about location, but it's true. And as I've gotten more experience in real estate, it just becomes more and more painfully true about how it's all about location. And so I would just consider a good deal, first and foremost, the location. That's the part of the deal that you can't change, and it's the most important. And so we're looking for suburban assets, generally speaking. So in the suburban segment of multifamily, we're looking for a deal that has majority 2-bedroom and 3 bedrooms. We want the larger floor plan, the better. We want the better school districts. We want the higher median household income. And then obviously proximity to jobs, proximity to entertainment, retail, that sort of thing. So those are the makings of high quality. And then on the property side of things, generally speaking, you're just looking for newer is nicer. Now, there's some nuance with that because, maybe there's some case to be made that you might find a 2000s vintage deal that's actually higher quality than a 2020 deal, right? So there's not all construction is created equal, and there's a lot of very high quality deals built in the 2000s, maybe the 90s, kind of depending on what part of the country and stuff. But the 80s is where things are very cuspy, right? There's good quality 80s construction, then there's pretty bad that has kind of the hangover from 70s, because 70s, generally speaking, is fraught with all sorts of risk, like exposed aluminum wiring, flat roofs, cast iron plumbing.
Mm-hmm. Yeah.
Mm-hmm.
Yeah.
What, maybe speak to your, I'm kind of jumping around here, but thinking of your due diligence process now, like, could you maybe outline on the closing you guys just did, start to finish, from how long the underwrite took, offers in, offer accepted, to closing, and kind of your overall picture when it comes to analyzing, the first review, the final review, and then your investor flow of how many investors are in there, and just start to finish?
Yeah, my philosophy about evaluating a deal at the top of the funnel is that you really want to go deep on the qualitative before you start diving into the quantitative. Because if you dive into the numbers and start underwriting, you could just spend your whole day what ifs and how much and all that sort of good stuff. And then you could find out, the qualitative wasn't a fit all along, right? The schools were just too bad, or there's just too much crime, or whatever that your thresholds are. So that's why I want myself and my team spending the most time up front disqualifying deals in terms of qualitative stuff. Like, we really want to fall in love with, like I said, the schools, the layout of the property, and the median household income, the population growth, the supply story. So once we're good with all that, which most of the time we're not, right? We're just trashing the deal. And that was a very hard thing for me to do, because I always had this FOMO starting out. It's like, when I started out, I had this belief that I need to evaluate every single deal because I want to find that needle in the haystack. And what if, like, yeah, that deal's not in a good location, but what if it sells for cheap enough? Right. And I always had this I was like too smart. I was, actually not that smart, but in my head, I was like trying to outsmart everyone and think, well, there's a price for everything. But the reality is the market doesn't work like that, because deals aren't going to trade at the price you want necessarily. And so typically speaking, people are going to overpay for the bad located deal. And that's just the way it is. So don't spend your time on the bad located deal, bidding on it, hoping that it trades for, 20% below ask. Instead, lean in heavy on the deals that are high quality, that are worth overpaying for, because that's kind of the red pill about bidding on deals, especially at the institutional level, is there's no mispricings, there's no inefficiencies in the market. If there's a broker, there's a marketing process, generally speaking, and there's a lot of smart people looking at the deal, the winning bidder is the one who's dumb enough to pay the most. And that's just how it works. So if you're going to be prepared to show up and pay the most, it better be worth it, right? It better be for the right deal. So that's why we screen so heavily on the qualitative. And then once we start underwriting, we don't believe in back of napkin. We're not going to do a rough outline. We're going to fully underwrite the deal. We're going to put a budget together. We're going to kind of model out the financing, the business plan, and all that stuff, because there's just no room in being vague and kind of being rough with it. Like, if you're going to pursue a deal, you have to underwrite it fully, and you've got to find all the ways to add value. Kind of like you said, you came on the webinar to see, like, what are all the bells and whistles and ways that we're trying to push income. That's absolutely right. Like, we may not share all those details in the webinar, but we absolutely have to come up with every single way that we can push and justify the price of the deal, right? We have to be the ones who are crazy enough to think that we can make magic with the deal. Otherwise, someone will pay more than us.
Mm-hmm. And how long does your general fundraising window, as you guys, it's a go, green light? Do you often extend in those escrows? Are you often on time? Is it investor check size constantly increasing? Like, just maybe talk through that flow.
Yeah, well, first off, for all the brokers and sellers listening, we always close on time. Everything's always good. No retrading. But the reality is, typically what we'll do is, once we have an agreed upon offer, right, we'll typically take 2 weeks to negotiate and sign the contract. And within that 2-week window, we're scrambling to put together the preliminary package for the deal, because we know this is a live deal, right? We've got awarded the deal LOI stage, and we're going to send that package out to our top investors, our fund managers who raise capital with us. And then once the deal is actually under contract, that's when we'll start going from preliminary data room to more of like a formal pitch deck and get the PPM together and all the legal docs together. And so we'll typically, and of course we need to do due diligence in order to finalize all that. So in the first couple of weeks of being under contract, do the due diligence, get the legal stuff together, and then we typically go public, so to speak, with our fundraising about a month into the contract period. And then we take about a month to raise all the capital. So ideally try to close in 60 to 90 days. And we are, I said earlier in the show, these days we're raising about $15 to $25 million per deal. And the way that breaks down is we're typically raising from our direct, high net worth individuals. We're typically raising about 10 million. So the balance of 5 to 15 million is coming from our capital raising partners. So these are somewhat co-GP partners. These are fund managers who have their own network of investors that are signing on to the deal through a fund-to-fund structure, and they're going to raise $1 million, $2 million, $3 million, up to $5 million.
Mm-hmm. How did you get introduced to the fund of funds groups?
Yeah, the fund of funds has been a very powerful part of our business that wasn't really anticipated, but it was just by necessity, right? You put a deal under contract and you need to raise 10 million. It's like, well, if your network taps out, you need to go find some more people. And so it was born out of necessity. And at this point, it's become more of a legitimate industry in some way, because there's people that attend conferences that are geared around capital raising, and their whole business model is to partner with lead operators like us. They raise the capital for our deals, we manage it, but it's their investors and it's kind of their, it's their fundraise with their deal. So yeah, we've just built these relationships over many years at this point, and we continue to attract more of these partners just through, I'd say, word of mouth and attending different mastermind events.
Mm-hmm. Rob, the first time I read your stuff online, not thinking much of ever connecting, I guess. I read through your underwriting principles, and the first time I ran into you was, I don't know if it was the first Raise Fest, but it must have been first or second. It was in Louisville. And at that, you were speaking. And it was pretty funny to be like, oh, wow, that's the guy I just read about. And then during that conference, you pulled together a bunch of fundraisers because you were raising on a deal. And just out of curiosity, did that deal go through? I believe it was like a $20 million raise at that point, and it must have been 2 or 3 years ago. But that was when I first got introduced to the fund-to-fund, because at that point, we were operating and fundraising just on our own deals and not really bringing in outside partners. And I was like, oh, wow, that seems like a good synergy model there.
Yeah.
Yeah, I mean, the fund managers are great. It's great with scale. I think that it's very valuable. I can't say it's fully love-hate, but I do dream about just having deals that it's just all our own investors. We don't have the added complexity of all these different fundraisers and all this sort of stuff, but you got to do what you got to do. I'm trying to think. So that conference was in 2022, I want to say.
It was in Louisville. I don't remember the year. It must have been 22 or 3. And I don't think it was the first Raise Fest there.
might have been 2023. And in that case, we literally spent the whole year raising for this 3-property portfolio in Houston. It was a tax exemption deal. And at this time, the Texas legislature was coming down with some of these new law changes for the affordable housing stuff. And the mayor of Houston was getting a ton of pressure. So we had to do some backroom deals with the mayor to get him to approve our deal. It was miserable. So it took us 11 months to close that deal, which is not good for your capital raise, right? Sure, you have extra time, but the problem is the money that you raised in month 2, 3, 4, you've got to keep re-raising it, as my team kept saying. Craig on my team, he's like, yeah, I feel like we raised the money 3 times on that deal. And that was a $38 million raise, biggest portfolio, biggest raise we'd ever done. I don't even know how we did it. Like, I don't feel like we could do that today. So it was just, it literally was just a nightmare.
Yeah. Yeah. It was pretty fun to see, like, the whole team get assembled, and that guy that runs that conference was building it up pretty good. So it was fun to see. Like, it was a good case study for the group, for sure, on how to just push through the hard.
How much do your speaking engagements help you with your fundraising?
They certainly do. I think that the thing is you never know. And so you know for sure if you don't go, you're not going to get anything out of it. But if you go, you might get a lot, you might not. So it's kind of always a calculated risk of, okay, is it worth flying here? Is it worth going there? So overall, it's very valuable, social proof and those sorts of things. That does go a long way with investors. It goes a long way with fund managers. But I think at this point, like, speaking feels cool sometimes, but I'm also it's not necessarily something I particularly enjoy doing. So I'm trying to scale back in terms of my travel. And I try not to just say yes to every opportunity and really evaluate at this point, is it worth the time?
What does your day look like now? Like, is it all on the back end underwriting? Is it still a lot of fundraising efforts? Is it just operational? Like, what is it today, and what does it need to be in the next few years as you look forward?
My last year and change has been 90% operations. So since going down to Houston and coming back, it's been all about accounting. It's been all about asset management, property management, construction, and HR, all these sort of things that I had not really paid any attention to. So that's where my focus has been. And then as far as acquisitions, underwriting, and that sort of thing, I'm very, at this point, high level, hands off. Brad on our team is better than me. So he's running the charge in terms of sourcing deals, evaluating opportunities. So he's doing a great job there. And then also I have an amazing team now as far as investor relations. So kind of putting all the materials together, reaching out to investors, handling all that sort of stuff. So at this point, I try to do my best as a CEO and just lean in where I feel like I'm needed. And if I'm not needed somewhere, then I don't be there.
Can you tell us a little bit how your team is structured? You're the CEO, you're the owner of Lone Star Capital. Is your team part of your GP? Do you have a special share class for them?
Yeah, so certain members on our team do participate and get a share of the GP on a deal by deal basis. So the way that is structured just legally is every deal has a owner entity and a manager entity. And so the owner entity is where the investors will fund into. And so they have a partnership interest in the actual owner LLC. And then the owner LLC will be managed by essentially the GP manager. And so at the GP manager level is where I'll bring in employees or other partners at that level. So they'll get a share of the promote, they'll get a share of the depreciation coming by way of the individual deals manager GP LLC.
So are any of your employees that get into the GP, are they considered real estate professionals? So when they're taking depreciation on a $50 million asset, they're not capped out on what their losses can be, or I don't know how that works.
Yeah, I'm not a CPA, and I don't want to get anyone in trouble, but yeah, I guess short answer is yes.
Okay. That was our assumption as well, because we've talked about doing that for our employees. And everything that we've read, and ChatGPT, of course, has led us to believe that that would be the case. But we're also not CPAs, and so we haven't seen it on paper yet, I guess is what I'll say. But it seemed like that would be a huge benefit to our employees when we do bring them into the GP on projects with us.
For sure.
Yeah.
What kind of advice would you give us? We want to do what you do. We're kind of off to the races, and we're several steps behind you. But we're probably just because we're doing smaller deals. We're doing a lot of deals, but they're just not at your level. Looking back over you talked about how some of your regrets were wishing you had built that foundation from the beginning. And to me, I kind of imagine like trying to build the boat while it's already in the water and we're launching it. So I think we all kind of feel the same way as we don't know what we don't know. Is there a bit of advice you might give us starting out that, things that you learned along the way are something that you would do different as you get going?
So you mentioned that you guys are doing more volume and smaller deal size. So I think depending on what those numbers really break down to, you may consider the fund route. Now, I personally don't recommend it because raising a fund is 10x harder than raising for a deal, right? Just blind investments are much harder to sell on, right? Then you're really leaning in on an investment in you, an investment in your platform and your track record. So you're just pretty much always going to raise substantially more from your same set of investors for identified opportunities on a deal by deal basis. But if your strategy hinges on small deals, right, you're able to really create a ton of value because you've got these tiny deals and they're, because they're so small, they have a ton of value, whatever. Like if someone has that sort of strategy, then fine, raise a fund so that you can capitalize all those deals and it's feasible. I don't really know exactly what the threshold is, but that would be the first thing to consider. Part
of our problem is in our market, we don't have projects like the size you have in Texas. So like for us, like I was saying, like a 50 unit project in Oregon is a big project. That's a pretty, like we're closing today on a 70 unit portfolio. And to you, that's probably tiny. To us in the Oregon market, that's a pretty big deal.
Well, that's the biggest project that's sold in that market in the last
decade.
Yeah. I mean, the market that we live in, too, has two properties. Salem is where we're the capital of Oregon, has two properties that are over 300 units, I believe. There's one 512 unit that was built like 20 years ago, and then there's one 350 unit property that was built maybe 10 or 15 years ago, and that's it.
What's the price per door range on these deals?
On new construction, you're anywhere from
$2 to $250.
Yeah, $2 to $250 right now. I mean, 3 years ago that was $50K higher. And then on value add stuff, or even just like kind of stabilized assets that were built in the 80s or 90s, like you're talking about, 70s stuff is going to trade at, I mean, sometimes $100K to $125K right now, but then 80s and 90s is probably anywhere from the 140 to
150ish.
Yeah, 160K range.
Got it. So you might be looking at like $5 million deals as kind of that's
5
your
to 20.
universe.
Yeah.
Five to 10 is kind of our wheelhouse, I would say.
Yeah.
But we can do up to 20.
Cool. Well, the funny thing is when we started out, we were doing deals with much more debt, right? We were like most people starting out, it's like, well, we'll take as much debt as the bank will give us because the more leverage, the more my spreadsheet looks good and the less equity I have to raise. So when we were doing a $10 million deal, the raise might only be $3 million. And then now the way things are is we're doing 65% leverage and we're doing much bigger deals. So now it's like the raises are just enormous. And I really don't like it because the deals that I want to buy that are in the good location, that are newer, it's like kind of the opposite problem to you guys. They're 40, 50, 60, 80 million dollars. And it's like, I don't necessarily want to buy it just because it's big, but the deals I want to buy are big.
Yeah.
And I need to raise 20, 30, 40. And it's not perfect in alignment with my business goals. So it's kind of a similar but different problem with you guys. I would say, I mean, one thought is like, you might just have to get comfortable with expanding to a different market.
Yeah.
You guys are close to a lot of great markets, like in the Pacific Northwest, there's a lot of great markets. So you guys, I think, just have to take that plunge, which is just it's a mindset shift. It's just something that's like, are you yes or no?
Mm-hmm. Yeah, and we're starting to, like, our construction. I think part of our vertical integration is management in-house in the Valley, construction in-house, and it's like we just started a few developments a few hours away, and that's starting to feel more comfortable. And so now it's like, well, what's the difference between 2 hours or 5 hours? 5 hours and 12 hours. Yeah.
Do you have a jet, Rob?
Not me.
I heard investors don't like it when you buy jets.
Yeah, I heard that's when they stop investing.
Yeah, if I had one, I would not publicly advertise that.
Yeah. So he might have a jet.
Yes.
He might have a jet. We're not sure. That's funny. No, so you said that those raises that are $20 to $30 million don't align with your business goals. Speak to that. Why does that not fit, I guess?
Well, one of the goals of my business is for it to reduce my stress, right? And make me enjoy life more. And so if every deal has to be like this leap of faith and absolute max out risk, like whether we can raise all the money and close, I mean, that's just not conducive to my sleeping well at night. So I'd prefer just for our fundraisers to be a bit more manageable. So it could be a little more like blocking and tackling, line it up, shoot it down, because it makes me a little gun shy. It's like, I have to really love the deal. I have to be really confident of all the stars aligning in order to pull the trigger on the deal. But if the deal is 15 mil, it's like, okay, sure, let's put it under contract. Let's start raising around Christmas. Like, I don't care. Like, let's go for it. Right. Mm-hmm. But when it's kind of tapping us out, it just makes me a little nervous. And so I feel like it is what it is, and we're still, getting deals done, but it would just be a little easier.
Mm-hmm. Yeah.
How has the co-invest conversation ebbed and flowed in your career? At the start, was it a big deal? Is it a big deal now? What is that evolution?
That's a great question. I think that conversation hasn't really ebbed and flowed too much from kind of over the years. It's just changes a lot based on who you're talking to. I will say probably on a high level, it has kind of flowed, or I don't know which way you want to think about it, but it's not as much of a topic of conversation more recently than in years past. So I'm not sure exactly why, but obviously if you're speaking with like an institutional partner, family office, but more so like a private equity firm, a lot of those guys here in New York, they're like, yeah, you got to put in 10% of the money, and it's all very tough and serious, which I understand where they're coming from. But when you work with the high net worth investors, I think they understand more so where you're coming from. So if I tell them I'm putting in $500K, they get it like, oh, that's a big deal to you, right? So I just think it's so tone deaf when an institutional investor or some sort of kind of someone who's just out of the mix, and you're raising $20 million, and they're like, yeah, you need to put in 10%, you need to put in $2 million, and it better be net of your fees. So if you're taking $1 million acquisition fee, that means you need to put $3 million into the deal. It's just, this is tone deaf.
Yeah.
Yeah. So on your business goals, where do you want to go? What is that vision 5 years from now? Like, what's the Lone Star team going to look like?
Yeah. So over the next 5 years and beyond, the goal is to continue to scale, obviously buy better and better quality deals and scale into more markets so we have more diversification to offer investors. And like I said, I want to be able to continue to increase the amount of direct investors that we raise capital with, rather than going through, for lack of a better term, intermediaries of various types. The reasons for that is I just want more control, better margin, and my ultimate goal is basically every deal we do, I want to 1031 exchange. Mm-hmm. So I want to deliver such a great experience for investors that if every dollar they give us, I want it to basically be ours forever. And the way to do that is 1031 exchange. It's the best outcome for everybody. It allows us to kind of in a stable way grow our business, and then also it compounds investors' wealth the most effectively.
Mm-hmm. Can you speak to how you talk about exit strategy on when you're talking to investors and say, hey, the 3-year buy and sell or 5-year hold, or we're going to refinance in 10 years or 1031? That's kind of, so for your background, for me, my average deal size has been around $1 million. It's gone to $2 million. Right now I'm doing my first $6 million deals. So the discussion on the exit and why we're doing it this way is different than it ever has been for me.
I think when you're starting out, not that you are starting out, but when I was starting out, and to the more inexperienced investor, the quicker that they get their money back, the happier they think they're going to be. So if you tell them the business plan is 3 years, they go, oh, that's great. If you tell them 5 years, they say, okay, that's all right. If you say 7, they say, oh, I don't know, 10, forget about it, right? So that's not the type of investors I personally want. I want the investor that if I go to them and I say, yeah, we're thinking about this as a 10-year hold, I want them to be excited about that and go, okay, great. Like, you know what you're doing. That must mean this is a great long-term play. So, but nevertheless, we're not talking about the future. We're talking about raising money today. So I think a lot of our thought process is based on what our investors are looking for and what is the best fit for the deal. So when we're buying a deal, and also that changes based on the market cycle. Right now, I feel like we're closer to the bottom. And I think that the next handful of years are going to be great performing years for multifamily in terms of value appreciation, in terms of rent growth. And so I think that if you believe that, if you're a believer in kind of near term over the next 3 to 5 years, price appreciation, NOI growth, then I would say you probably want to bias towards shorter term debt, maybe 5-year debt. Anything shorter than 5 years obviously is more bridge loan and more risky. So 5 years is kind of the shortest that we'll generally consider. And that will allow you to monetize the near-term value creation as quickly as possible. So right now we're doing mostly 5-year debt, telling investors that we're looking to sell or refi within 5 years. As the cycle progresses and values have appreciated and the market's more competitive and we see less upside potential in the deals that we're acquiring, and also the greater risk of a downturn, we're going to want to increase the length of term on our debt. So if we're going to be locking ourselves into 7-year debt and then eventually even into 10-year debt, when we're thinking, you know what, the market's pretty pricey, we might have to ride a whole downturn and then a rebound before we can really maximize the value of this investment, that's going to be a tougher sell for investors. But we're going to have to tell them, like, hey, look, we're locking in 7-year debt. That means there's not going to be much happening with this deal until at least 5 years in. So that's where we are in today.
Yeah. So essentially you're saying when you're having the communication with investors about exits, you're having to explain market cycles, which makes total sense, right? It's your job to understand all of that stuff. I mean, you understand multifamily real estate and the cycles of multifamily real estate ideally as well or better than your investors. And so when you're having the conversation about exit, it's changing all the time because, like, I guarantee your conversation in 2020 was not the same as the conversation that you're having right now, right? You exited 2 properties in 2022, which makes a lot of sense. And I think that those exits probably look good to investors. But I think talking about exiting properties in 2026, those 3 that you plan to exit next year, that's going to be so much bigger for your track record to say, hey, we bought these deals in 2020. The market peaked out in 2022, and we still gave this return to investors like right out of the bottom of the market, which I would agree with you that it's been, the last year or right now, maybe it's coming in a month. I don't know. I think we're kind of coming out of the dip. And so I think that's going to be huge for you guys to say, hey, we exited these 3 properties. Here's our full business plan as it performed from 2018 to 2022. And then here's what we had to do from 2020 to 2026. Here's the difference in those 2 cycles. And this is the type of investment we're entering now. And this is why we have the timeline that we have on it.
That's right. And it's not the most pleasant conversation when an investor calls you and says, why aren't we selling right now?
Yeah.
Like, we're ready.
Right now, we might actually lose a lot of money.
I don't think you'd like it if we sold right now.
Bring me a buyer that'll pay 2022 pricing, and we will.
Yes, please.
Yeah.
Well,
no question.
Rob, as we wrap up, what is your biggest challenge right now, and how are you going to combat that as you look forward to the next few months and year?
Our biggest challenge has been hiring, and it really stems to going back to what I mentioned earlier about building the foundation right and unfortunately rebuilding it. It's a lot of hiring to do in a short amount of time. So when we let go of our entire management leadership team, that precipitated a lot of turnover at the property level as well. And so you don't just rebuild amazing teams overnight. If you had C players at a property and you fire them and you try to rehire quickly everyone, you're not going to just magically go from C's to A's. And so we've just gone through multiple rounds of turnover, and just we're cultivating amazing teams. And I view it similar to a portfolio of properties. It's like a collection of amazing people, and you don't just build an amazing rare collection overnight. So that's our big challenge, because our team will say, we need to hire this person. Why isn't it happening tomorrow? Well, the applicants are who they are, and we're not going to some extent, we're going to try our hardest to not lower our standards for who we're looking to hire, just because we're, to use a good phrase, under the tyranny of the urgent.
Yeah, no, that makes total sense. Do you think that part of the difficulty, I guess, just because we've always been within our own network, I guess our market is where our network is. And so when we're hiring, the people we're hiring are usually just people that we ask our network, like, hey, this is who we're looking for. And then we get, 5 people from people that we trust recommended to us. And so we don't have to really hire everybody from some third party software, right? Or some platform where we're just meeting random people and having to go through 200 applicants. We're kind of getting that team. So do you think that part of that in Houston has built up over time, where now, Texas generally, where now people know who you are and you're getting recommended employees? Have you seen that at all?
Absolutely, yeah. Just in the same way that you get investor referrals or resident referrals, employee referrals are great. And we pay our employees $500 for an employee referral. We pay our residents, I think we've even done $1,000 bonus for employee referrals. So it's huge. I mean, and also it's big on the maintenance side too. These maintenance guys are well connected. If they're working in a certain trade, maybe in a different life, they were working alongside another guy who's got some skills, and bringing them in with kind of a bit of vetting is so valuable, because a lot of maintenance guys will show up and it'll say anything on their resume, HVAC certified and this and that, but really they don't know anything. So it's always a challenge. There's more turnover on the maintenance side.
Yeah, no, that makes sense. Well, we want to be respectful of your time. We got you for an hour and we went a little bit over, so I appreciate that. Any final questions for Rob before we get him out of here?
No, let's let him go. Rob, you're amazing. Thanks so much for being on Deal Junkies.
Yeah.
It's been an honor to have you on here, and I'd love to follow up one day and have another conversation.
I had a great time. Thanks for allowing me to be your first virtual guest.
Yeah, I appreciate
We'll
that.
do it again.
Set the bar high.
We'll have to get you out here or meet you at the World Trade Center sometime. That'd be awesome.
Either could work. Craig, who was my best man at my wedding this year, and also is my main sales guy, investor relations guy. He loves Bend, Oregon.
Oh, okay.
So
It's not far from us.
he's in Bend a lot, so we can maybe make some sort of connection happen, whether I'm in Bend this summer or he'll be hanging out there, I'm sure.
That would be awesome.
That'd be awesome.
Right.
All right, Rob Beardsley, CEO and founder of Lone Star Capital. What an amazing episode. Thanks so much for being with us today, Rob. Deal Junkies, we love you guys. Please share this episode, and we will see you next time.